So
Yeah.
it's kind of surprising, isn't it? The capital asset pricing model, CAPM, yeah, it's this huge idea in finance.
Foundational, really.
Exactly. It's supposed to explain risk and return, but, it often feels like, well, like it doesn't quite match what happens in the market.
Mm. Like a theory that looks great on paper, but sometimes
Right.
stumbles.
Yeah, stumbles on the runway, maybe. It's that gap, that disconnect we want to dig into today.
Right. And we're using this really interesting research article, The CAPM Strikes Back, as our guide.
Okay.
Now, for you listening, if maybe finance isn't your day job or you haven't thought about CAPM in a while, it's basically a model trying to tell you how much return to expect for taking on a certain amount of risk.
Right, it underpins so much of investment thinking. So the million-dollar question is, why does it seem off so often? What are we missing here? That's the aha moment we're shooting for.
Exactly. And hopefully, without getting lost in, super complex equations. This paper uses economic models, but also looks hard at historical data. It looks at the key APM's track record, this thing called the beta anomaly, and even another model, the consumption CAPM.
Okay, consumption CAPM. We'll get to that.
We will. It tries to link asset prices to, well, how much stuff we're all buying.
Interesting. So our mission today, pull out the key ideas from this research. Why does the CAPM struggle? And what are some maybe better explanations?
Let's do it.
Okay, first big puzzle. The paper says the CAPM has trouble with the value premium. What is that exactly?
So the value premium is a pretty well-known thing in finance. Basically, over long periods, stocks that look, let's say, cheap compared to their book value stocks,
Right.
they tend to give higher returns than expensive stocks, growth stocks.
Right, the high flyers versus the more solid, maybe less glamorous ones.
Sort of, yeah. And this difference, this premium for value, has been really noticeable in the data, particularly after July 1963. There's some famous work by Fama in French on this.
So this isn't just like a blip. We're talking decades of data showing this.
Absolutely. The researchers here looked at monthly returns going way back, July 1926 to June 2017. Huge data set.
Wow.
And they grouped stocks based on that book-to-market ratio, basically sorting them from growth to value. And pretty consistently, as you move toward the value end, the average return you get above just a safe T-bill, it goes up.
Okay, that might sound reasonable. Maybe value stocks are just riskier, higher return for higher risk.
You'd think so.
Yeah.
That's what the CAPM would suggest. But here's where it gets really interesting.
Uh-huh.
The CAPM measures risk using beta, right? How much a stock moves with the overall market.
Yeah.
But when you measure the beta of these value stock groups versus the growth stock groups, it's basically flat. Not much difference in beta.
Wait, flat. So the risk measure stays the same, but the returns go up for value.
Pretty much. The paper highlights this. If you build a portfolio that goes long value stocks and short growth stocks, the value minus growth portfolio, it has a tiny beta, like 0.07.
Okay.
But the return difference is significant, 0.47% per month on average.
So CAPM says these value stocks aren't much riskier, market risk-wise, but they're paying out way more, that gap. That's the alpha, right?
That's the alpha. And it's economically significant, especially
Yeah.
post-1963. It just screams that beta, the CAPM's risk measure, it's missing something.
Yeah, it's blind to whatever is driving those higher value returns. Some other kind of risk, maybe.
Exactly. What is that risk? Now, there's a bit of debate, the paper mentions, about whether the CAPM failure is mostly a post-63 thing or if it was always there. Different researchers see it slightly differently.
Okay.
But the consensus leans towards it being more pronounced recently. They even looked at how this value premium behaved during huge events like the Great Depression or the 2008 crisis.
And even then, value often held up better or recovered.
The tendency was often still there, yeah. It's quite persistent.
Okay, so point one, CAPM struggles with value. Got it. Let's move to the next head scratcher, the beta anomaly. This sounds like CAPM has issues with its own main tool, beta itself.
You nailed it. The beta anomaly is this finding. It's a bit counterintuitive. It shows that often there's a flat or sometimes even a negative relationship between a stock's beta and its average return.
Negative. But CAPM says high beta, high risk should mean high return.
Exactly. That's the prediction.
Right.
More risk, more reward. But the data often just doesn't show that clear link.
So stocks that are theoretically riskier, more volatile with the market, aren't reliably giving you higher returns.
Precisely. The paper talks about how they test this. They sort stocks into groups based on their past betas, maybe calculated over the last 5 years or so.
Standard approach.
Yeah. And they find, like others before them, that the low beta stocks often have returns just as good as, or sometimes even better than, the high beta stocks.
That is wild. So you could potentially take less market risk, according to beta, and get similar or even better results.
Mhm.
That feels almost backwards. Low risk, high return potential. That completely messes with the simple risk reward story.
It really does. It seriously challenges the idea that beta is the only risk that matters for returns.
Okay. CAPM struggles with value, struggles with beta itself. Now, the paper also mentions the consumption CAPM. What's the thinking there, and why does it fall short, too?
Right, the consumption CAPM, or CAPM, it's a different angle. Instead of market risk, it says what really drives asset prices is how much overall consumption is growing in the economy.
Okay, so it's about our collective spending habits.
Kind of. The deep idea is that investors ultimately care about being able to consume things in the future. So an asset that pays off really well when times are good and everyone's already consuming a lot, well, that's less valuable than an asset that pays off when times are tough and consumption is low.
Like insurance. You want payouts when things are bad.
Exactly. It provides value when you most need it. So the theory predicts assets that co-vary positively with consumption growth, that do well when consumption is high, should have lower average returns.
Okay, that makes sense intuitively. So how do they test it?
They look at historical data on aggregate consumption nationwide spending, often going back to the late 1920s or 1940s. They calculate a consumption beta, how sensitive an asset's return is to changes in consumption growth.
And then see if assets with higher consumption betas have lower returns.
That's the idea. But the results are generally pretty weak for the standard version.
Doesn't work out so well in practice.
Not really.
Yeah.
The paper points out that these consumption betas often aren't statistically significant. They don't reliably predict returns. And worse, sometimes the price of this consumption risk is insignificant or even has the wrong sign.
Wrong sign, meaning it suggests investors like assets that pay off when times are good.
Yeah, which is the opposite of the theory's core logic. Plus, overall, the model just doesn't explain much of the difference in returns we see across various assets. Low R squared, as they say.
So just looking at broad economic consumption trends isn't a great predictor of investment performance either.
The simple linear version seems to struggle, yeah. They do mention a tweak looking just at fourth quarter consumption growth, which seems to do a bit better, but still, it's not a magic bullet.
Okay, so CAPM, beta anomaly, consumption, CAPM. They all seem to hit roadblocks with real-world data. This paper, the CAPM Strikes Back, must have an explanation then, right? What's their big idea?
Their big idea is, well, it's pretty compelling. They argue that if you build an economic model that explicitly includes the possibility of rare but really severe economic disasters and allows different companies to be hit differently, that model can actually explain a lot of these puzzles.
Rare disasters, you mean like Great Depression level events, or
Yeah.
maybe something like the 2008 crisis, but worse.
Exactly that kind of thing. A large, sudden, unexpected shock to the whole economy's productivity.
Okay, so how does adding that possibility change things?
Their model has a few key ingredients. First, these disasters make the way the market values future money much more complex. It's not a simple straight-line relationship anymore, especially when you factor in the fear of a disaster.
The fear itself matters.
Hugely. Second, it's a general equilibrium model. Everything affects everything else. Consumption, investment, prices are all determined together. Third, it has different types of firms, heterogeneous firms, that react differently to shocks.
So not all businesses get hit the same way by a disaster.
Precisely. Some might be more vulnerable. The model also includes different economic states, normal times, disaster, recovery. It has realistic features like it being costly for firms to downsize quickly and firms can enter or exit the market. And finally, it uses a more sophisticated model of how people feel about risk over time.
Okay, sounds quite involved, but what's the core intuition? How do these rare disasters make the regular CAPM look bad?
The intuition is that these disasters, even if they haven't happened recently, cast a long shadow. Value stocks, the ones that seem cheap. The hypothesis is they're actually more sensitive to the possibility of these rare, catastrophic downturns.
So the missing risk in the standard CAPM for value stocks isn't everyday market bumps, but this lurking vulnerability to really extreme events.
That's the core insight. So if you just look at data from normal times, which is most of the time, thankfully your standard beta calculation only picks up how stocks move together during those normal periods.
Right.
It completely misses this potential for a much bigger hit during a disaster, a risk that might be higher for value stocks.
That makes a lot of sense. If the disaster hasn't actually occurred in your sample period, How would a simple linear model like CAPM possibly pick up on that specific vulnerability?
Exactly. And their model shows this. In simulations without realized disasters, it replicates the flat beta profile across value and growth, and it replicates the value premium, the alpha, just like we see in the real data, especially post 63.
Okay.
But then when they run simulations with rare disasters actually happening, boom, the CAPM suddenly does a much better job explaining the value premium.
Because the measured beta now reflects that disaster co-movement.
Precisely. The beta calculated in those disaster-inclusive samples becomes a much better proxy for the true underlying risk, including that disaster sensitivity.
So it's not that CAPM is fundamentally broken, maybe, but that our typical data, thankfully lacking frequent disasters, doesn't let it see the whole picture, especially the tail risk part.
That's a really good way to put it. They show the relationship between risk and return gets very non-linear when disasters are possible, making the simple linear CAPM a poor fit. The market's way of discounting the future gets really complex too.
Okay, that explains the value premium puzzle, potentially. What about the beta anomaly? Why don't high beta stocks reliably outperform? How does the disaster model explain that?
Well, the model also generates that flat relationship between historical beta and average returns in its simulations. It looks like the real-world anomaly.
Okay, so it replicates the problem. What's the reason within the model?
Their explanation boils down to measurement error.
Measurement error. You mean the beta we calculate isn't quite right?
Exactly. Beta calculated using past data, say a 60-month rolling window, is just a noisy estimate of the true, possibly time-varying market sensitivity of a stock.
Ah, the real beta might be changing, and our backward-looking measure has lag and noise.
Precisely. So in their model, the true underlying conditional beta does line up with expected returns. Higher true risk means higher expected return. But when you sort stocks based on these historical, noisy, backward-looking beta estimates, that relationship gets totally blurred.
It's like trying to group sprinters based on photos taken a minute after the race started. You won't get a clean sorting by speed.
Great analogy.
Yeah.
That's the idea. The noise in the historical beta measurement obscures the true underlying relationship between risk and expected return.
So the beta anomaly might be more about the difficulty of measuring beta accurately in real time than about beta itself being irrelevant.
That's a big part of their argument, yeah. It fits with other research showing how tricky risk measurement can be.
Okay, fascinating. So, last piece, the consumption CAPM. How does the disaster model explain why that one performs poorly in standard tests?
The disaster model also replicates the weak results of the standard CCAPM,
Oh.
the insignificant risk prices, the low explanatory power.
Okay, and the reason?
The reason they argue is that aggregate consumption growth, just total spending in the economy, is actually a pretty poor proxy for the true, complex, disaster-sensitive way the market values future outcomes in their model.
Why? You'd think spending would reflect economic health pretty well.
Well, people tend to smooth their consumption. We try not to drastically cut spending overnight, even if we fear bad times might be coming. We dip into savings, maybe borrow.
Right, we resist big changes to our lifestyle if we can.
Exactly. But the market, being forward-looking, can react much more sharply and immediately to the perceived risk of a disaster. Asset prices can drop quickly based on fear, even before actual consumption falls off a cliff.
So the stock market reacts to the threat much faster and more dramatically than our aggregate shopping habits do.
That's the essence of it. Consumption is too smooth, too slow-moving compared to the market's pricing kernel, especially when disaster risk is a factor. And they show this. When they test their model using the model's own internal complex pricing kernel, the thing that truly reflects disaster risk instead of using aggregate consumption growth as a proxy, the results look much, much better. Significant risk prices, higher R-squareds.
Ah. So the problem isn't necessarily the core idea of consumption-based pricing, but the proxy we use, aggregate consumption, is just too blunt an instrument, especially when dealing with rare extreme events.
That seems to be the message. The underlying theory might hold if you could perfectly measure the right state variables, but aggregate consumption isn't it. They also mentioned their model helps explain why the value premium is often even bigger for small-cap stocks. Smaller firms might be more vulnerable to disasters.
And just quickly, they checked if these results depend heavily on specific assumptions about the disasters.
Yeah, they did robustness checks, varying things like how likely disasters are, how bad they are, how long recovery takes. The core findings seem to hold up across a reasonable range of possibilities. The disaster mechanism seems robust.
Okay, great. Let's try and pull this all together. What are the really key takeaways from this deep dive into the CAPM Strikes Back?
I think there are a few big ones. First, that the known issues with the standard CAPM, like failing to explain the value premium, the weirdness of the beta anomaly, and the poor results for the consumption CAPM, might actually have a common explanation. The existence, or even just the possibility, of rare but severe economic disasters.
These disasters mess with the simple linear relationships assumed by the standard models.
Exactly. They introduce significant nonlinearity and make risk much more complex than just market beta. Second, measurement matters. Noisy historical betas make it hard to see the true risk-return relationship, contributing to the beta anomaly. And third, aggregate consumption is likely too smooth and slow-moving to be a good proxy for the true economic risks priced by the market, especially disaster risk.
So for you listening, understanding this gives you a maybe more nuanced view of market dynamics. It shows the limitations of those simpler models we often learn first. And it really highlights the potential importance of these tail risks, low probability, high impact events.
Right. It helps reconcile some of that disconnect we started with the gap between the neat theory and the messier reality
Yeah.
by adding this crucial element of rare extreme events.
Yeah, it definitely provides some aha moments about why things sometimes look so strange in the data. It's giving me a lot to chew on, which leads to maybe a final thought.
Hmm.
If these standard models really do struggle with extreme events, how should we investors, policymakers, actually incorporate the possibility of rare disasters into how we think and plan? Does this mean our whole concept of risk needs an upgrade beyond just beta? It feels like there's this whole other dimension of risk, this disaster risk, that maybe we haven't been paying enough attention to.